There are signs that investors should be concerned as the inflation makes a comeback and takes a path similar to the 1970s, and that means the Federal Reserve can't afford to declare victory just yet. The target rate of 2% is nowhere near, which the Fed is actually expecting. Strategists pointed out to the possibility that the US and other economies could re enter a period of stagflation. So, what exactly is stagflation? Stagflation is where the economic growth goes down and the inflation goes up at the same time, with consumers' expectation for future inflations spiraling out of control. That could result in a high period of inflation and sluggish economic growth, a situation that slammed the economy during the 1970s and the early 1980s. So, will the stagflation situation be avoided or is it unavoidable? The US is showing signs of stagflation spiral could be avoided. Monetary policy has already been tightened dramatically, with the Fed having hiked interest rate by 525 basis points, so that's like 5.25%, to slow the inflation surge. The central bank has also shed over 1 trillion of assets from its balance sheets, which has drastically reduced the amount of cash sloshing around in the market, and that has also helped to bring down the asset prices. Now, where once the Fed's portfolio held around was 8.4 trillion in assets, the institution's system's open market account now shows that this has fallen to just below 7.3 trillion. These balance sheet reduction efforts are more commonly known as quantitative tightening. So, what happens when the economy is not performing well, or we just have got into recession? What the Fed came up with was quantitative easing after the Lehman Brothers collapse in 2008, and similar situation after the COVID pandemic induced lockdowns. So now what is happening is they are going for a quantitative tightening. Now, this is totally a different play over here, and a strategy developed by the central bank is to drain excess liquidity from markets. Now is not the time to get complacent, and there are very strong reasons for caution. That's what economists are warning. So, what I've come up here with is I've come up with 4 reasons why markets should be concerned about a resurgence in inflation. The Fed is making people believe that there might not be a surging inflation because they are tightening now. But the economists and analysts all over the world are warning that the Fed might be wrong, where they cannot suppress the inflation back to 2%. So here I have found 4 reasons where you should be cautious. Inflation is still above target in every G7 nation. So all the great 7 countries have an inflation target. Some might have 2% or 3%, but the inflation is very much above that from the past 1 year or so. So prices have stayed well above central bank's target in most advanced economies. US inflation re-accelerated to 3.7 per year in August, and we saw not much decrease in September as well. So as per the latest consumer price index report, it is growing at a faster clip than 3.2%, which was recorded in July. So that's straight 3 months of increasing inflation. The second point I think is, which is most important, is a new price shock could easily unanchor inflation expectations. So what we have seen in history is that when you target something to be at a certain percentage, it never actually does that. It never actually comes to that point. And so what the Fed is actually now doing is they want to restrict the inflation to 2%, and they say that the normal inflation is 2%. But what happens if it doesn't come back to 2%, and if it keeps growing to like 5% or maybe 10% in the coming 1 year? That's going to be a very difficult situation for the Fed. So that's because inflation has stayed above above the central bank's target for nearly 2 years, and remains above pre-pandemic levels in the US and the much of Europe. So if there is another shock and inflation remains above target into the third or even the fourth year, it is increasingly difficult to imagine that the long term expectations will still remain at 2%. I mean, it doesn't make sense to keep it at 2%, and the Fed can then fool the people and fool the world by just taking the expected inflation to 3% and saying that, okay, now this is the new normal. The 2% is not the normal anymore, and it's now 3%. So all this can happen, and we have seen in the past the central banks have done that smoothly over the years by twisting their words which they speak during the FOMC meeting. And this is not only the US, but it's like the world over. I've seen this happening in India, I've seen this happening in Europe. So the situation is pretty scary right now. The third point, which I find, is the economic growth is sluggish. Now, with all what we have seen, the interest rate being at zero, the economy has not picked up like it should have. Now, tighter financial conditions have begun to take a toll on the economy, and there's little room for that to change. We saw bond yields surge as investors priced in higher for longer interest rates, which could raise borrowing costs on debt and hinder growth. The other important concern is what we have on the screen right now is the US debt to GDP ratio. Now, the debt to GDP ratio has also soared well above what it was in the 1970s. So, which limits the amount of fiscal stimulus that can be used now to stoke the economic growth. So, we have already pumped in so much of money uh, that now it's there's not much room to pump more money into the system, and there's not much room for easing anymore, in other words. And that could actually encourage inflationary condition even more if we try to pump up more money. And we might see a double digit inflation. So, what has happened is from the past 3 to 4 months, the numbers have come in favor of the central banks. And now they are boasting that, see, what we did was we increased the interest rates and things are coming back to normal. But it might not be the case, actually. Easing monetary policy to aid growth may also be out of question now, because how because it all depends upon how sticky the inflation is. And I think and what I read from the top economists in the world is that this inflation is not going to go away soon, because we had pumped so much money into the system, and that's the reason why. The last point I think is uh, the Fed's last attempt, the last stretch against the inflation war is actually the hardest, and things are about to get broken if we try to simulate the economy at the same time increase the interest rate to fight against the inflation. So it is difficult to say when the Fed should begin easing monetary policy, as right now there's no chance. And recently we saw they kept the rates at the same level. So as inflation inches closer to its target, markets put more pressure on the Fed to slash interest rates, as higher borrowing costs weigh heavily on asset prices. So what happens if, even though, let's say, the inflation sticks around 3%, or maybe just sticks below 3%, then there will be pressure on the Fed to ease the interest rate. And where do we go if we ease the interest rate at this point? We come back to the same situation where we are actually putting in money into the system, and we can't afford that anymore. Well, that's magnified by the fact that the monetary tightening works with a lag in the economy, meaning rate hikes delivered 18 months ago may not have been felt yet. And that all raises the risk the Fed could overdo it and push the economy into a recession, which I think the economy has already gotten into one. A key concern of markets over the past year is that whether we can do any soft landing. It will be very difficult to say at this point of time. Over the past 18 months, there have been a lot of promising signs that a return to the 90s, 70s can be avoided, but for the time being at least, it is too early to sound that clear. And what analysts and economists all over the world are screaming is that we are just balancing the whole economy on a very thin ice. And that could be one of the issues that where we cannot cut the interest rate, so we cannot stimulate the economic growth. And if inflation spirals out of control, we are in a precarious situation. Thank you for watching. If you like this video, please share, subscribe,